The increase printed on your Social Security notice is not the increase that will necessarily reach your bank account. That is the first thing every retiree needs to understand, because the number Social Security announces and the money you can actually use are two different numbers. In 2026, Social Security benefits received a 2.8% cost of living adjustment. Many people saw that percentage and assumed their spending power had finally increased. But Medicare Part B also became more expensive. The standard Part B premium rose from $185 a month in 2025 to $202.90 in 2026. That is an increase of $17.90 every month before you buy groceries, fill a prescription, pay the electric bill, or put 1 gallon of gas in your car. Pay close attention to this because a small misunderstanding here can cost you money for the entire year. Suppose your gross Social Security benefit was $1,700 a month. A 2.8% adjustment adds about $47.60. That sounds like an extra $571 over 12 months. But if your Medicare Part B premium rises by $17.90 a month, nearly $215 of that annual increase is already gone. Your real monthly improvement may be closer to $29.70 before federal taxes, Medicare income surcharges, voluntary tax withholding, prescription costs, insurance premiums, or any other deduction connected to your record. This is how retirees lose money silently. Nobody has to enter your home. Nobody has to remove cash from your wallet. The amount simply disappears between the gross figure shown on the government notice and the net deposit that arrives in your checking account. Most people never compare those two numbers carefully. They see a larger benefit on paper, notice that the deposit increased slightly, and assume everything is correct. The deposit may be correct. That does not mean the result is good for you. I have spent decades studying how Social Security, Medicare, the IRS, retirement accounts, banks, and credit systems connect. What worries me is not one dramatic law that takes everything away overnight. What worries me is the series of small rules that touch the same dollar several times. A retiree can receive a benefit increase, lose part of it to Medicare, create a tax bill by taking money from an IRA, raise a future Medicare premium because of that withdrawal, and then pay higher prices at the grocery store. Every individual step may be legal and correctly calculated, yet the retiree still ends the year with less purchasing power. That is the change most people miss. Social Security is not operating alone. Your benefit sits inside a larger system. The Social Security Administration calculates your payment. Medicare may take premiums directly from it. The IRS may tax part of it based on other income. Your bank receives the net amount. Your retirement plan reports distributions. Your employer reports wages. Financial institutions track transactions under federal banking rules. The information moves quietly between records, forms, databases, and computer systems. This is happening quietly, and it affects both lower-income retirees and comfortable middle-class retirees. The details are different, but the danger is the same. People assume that something will happen automatically because the government already has their information. Many important protections are not automatic. You have to notice the problem. You have to understand the notice. You may have to report a change, file a form, correct an earnings estimate, request a review, appeal a Medicare surcharge, or claim a benefit that the system will not choose for you. Nobody is going to sit at your kitchen table and explain each connection. Social Security will explain Social Security rules. Medicare will explain Medicare premiums. The IRS will explain tax rules. Your bank will explain its own procedures. Your retirement company will explain the account you hold with them. But the loss often appears in the space between those institutions. That is where people get hurt. A retired couple can receive a larger Social Security payment in January and still feel poorer by March. A widow can see her household income fall after her husband dies, yet receive a Medicare bill based on income from a year when both spouses were alive. A man can return to part-time work because property taxes increased, and then discover that Social Security withheld several checks because he had not yet reached full retirement age. A teacher can qualify for a larger benefit after the end of the windfall elimination provision, but fail to review whether the correct work and pension records are on file. A person can sell an investment to repair a roof and unknowingly push income across a Medicare threshold. None of these people are foolish. Most of them did what responsible Americans were told to do. They worked. They paid taxes. They saved what they could. They trusted official letters. They assumed that if something important changed, somebody would contact them clearly. The system does send notices. The problem is that the notice may explain the calculation without explaining the financial impact on the rest of your life. Here is what almost nobody understands. Social Security does not look at your retirement the same way you do. You look at whether you can pay for food, housing, medicine, insurance, and emergencies. Social Security looks at earnings records, claiming dates, age rules, benefit formulas, family status, and reported income. Medicare looks at coverage and income-based premiums. The IRS looks at taxable income. A bank looks at deposits, withdrawals, identity checks, fraud risk, and patterns required by banking law. Each institution sees one part of you. You are the only person who sees the entire household. That means you must stop treating the Social Security deposit as one simple payment. It is the final result of several decisions. When you claimed matters. Whether you still work matters. Your birth year matters. Whether your spouse worked matters. Whether you receive a pension matters. How much you withdraw from a traditional IRA matters. Whether you filed taxes jointly or separately matters. Whether your income recently fell matters. Even the timing of a large withdrawal can matter. The first major revelation is simple, but it changes everything. The amount you receive is not controlled only by the Social Security benefit formula. It is controlled by the order in which several systems touch your money. Think of a dollar moving through a narrow hallway. Social Security places the dollar at one end. Medicare may take a portion. The IRS may later claim a portion. Inflation reduces what remains. A bank fee may reduce it again. A higher insurance premium can remove another piece. By the time the dollar reaches your daily life, it may no longer buy what you expected. This is why a 2.8% cost of living adjustment should never be judged by the percentage alone. The average retired worker's monthly benefit was estimated to move from about $2,015 before the adjustment to about $2,071 after it, an increase of roughly $56. But an average is not your payment. Your benefit may be smaller or larger. Your Medicare deduction may be standard or income-related. Your tax situation may be completely different from the person living next door. Most people hear that the average benefit increased and quietly compare themselves to an imaginary retiree. That is a mistake. Your protection begins when you compare your own records year by year. Look at the gross benefit. Look at the Medicare deduction. Look at federal tax withholding. Look at any adjustment or recovery amount. Then compare the net payment with the amount actually deposited. A difference does not always mean an error, but a difference you cannot explain deserves attention. I want you to imagine a woman named Carol. She is 71, lives alone, and receives $1,780 a month in Social Security. Her notice says she is getting an increase. She feels relieved because food and property insurance have become more expensive. When January arrives, the deposit is larger, but not by as much as she expected. She assumes taxes took the difference. Taxes did not take it. The Medicare premium changed. Because it was deducted before the payment entered her bank, she never saw the full increase. She did not lose a check. She did not receive an alarming letter. The money simply never became available for her household. Now imagine Robert, who receives $2,400 a month and has money in a traditional IRA. His roof begins leaking. He withdraws $35,000 to pay for repairs, taxes, and a new heating system. The withdrawal solves the immediate problem, but it also raises his adjusted income for the year. That can affect whether part of his Social Security becomes taxable. It can also affect his Medicare premiums later because Medicare generally uses tax information from an earlier year when setting income-related charges. Robert sees one withdrawal. The system sees taxable income, a retirement distribution, a possible change in the taxable portion of Social Security, and information that may later be used for Medicare. This is the pattern I want you to recognize. One action can appear in several places. The Social Security Administration announced several important 2026 figures. The taxable wage ceiling for Social Security rose to $184,500. The amount needed to earn 1/4 of coverage rose to $1,890. The earnings limit for a person under full retirement age for the entire year rose to $24,180. For a person reaching full retirement age during 2026, the higher limit is $65,160 and applies only to earnings before the month full retirement age is reached. These are not small details buried in a government chart. Each figure can change a real household's cash flow. The earnings test is one of the most misunderstood rules in retirement. People hear that they are allowed to work while receiving Social Security and assume they can earn any amount without affecting their checks. That is true after full retirement age. It is not always true before full retirement age. In 2026, if you are under full retirement age for the entire year, Social Security can withhold $1 of benefits for every $2 you earn above $24,480. That limit is based on earnings from work, such as wages and net self-employment income. It does not include pensions, annuities, investment income, interest, veterans benefits, or most other retirement income. Watch how this works. Imagine a 64-year-old man named David. He claimed Social Security early and receives $2,000 a month. He also works part-time at a hardware store. His yearly wages reach $34,480. That is $10,000 above the 2026 limit. Under the basic rule, Social Security may need to withhold $5,000 in benefits. David may have accepted more work because his car needed repairs. He may already have spent the wages on medical bills, rent, food, and insurance. Then he discovers that future Social Security checks will be withheld to account for excess earnings. The rule is not a fine. It does not mean he did anything illegal, but the cash flow shock is real. This is where fear enters many homes. The person opens the bank account expecting a deposit and sees nothing. The mortgage is due, the pharmacy is waiting, the utility company has scheduled an automatic payment. The retiree calls the bank, but the bank cannot explain a payment Social Security did not send. He calls Social Security and learns that benefits were withheld because of earnings. He says, "But I paid taxes on that work." That does not remove the earnings test. He says, "But I am already receiving retirement." That does not mean he has reached full retirement age. He says, "But Social Security knew I was working." That does not always mean the correct earnings estimate was on file at the correct time. This is not automatic. If your expected wages change, you may need to update Social Security. If you estimated $20,000 and later accept overtime that raises your wages to $32,000, the system may need a new estimate. Waiting until the wages appear on a tax record can create a future adjustment when you are least prepared for it. The benefits withheld under the earnings test are not simply treated as if they never existed forever. After you reach full retirement age, Social Security can recalculate your payment to give you credit for months in which benefits were withheld. But that later recalculation does not pay today's electric bill. It does not stop a checking account from going negative during the month when a payment is missing. This is why I tell people not to ask only, "Will I eventually get credit?" Ask, "What happens to my household during the months when the checks are withheld?" Those are two different questions. The rule becomes different in the year you reach full retirement age. In 2026, the higher earnings limit is $65,160, and Social Security withholds $1 for every $3 earned above that amount before the month you reach full retirement age. Beginning with the month you reach full retirement age, there is no earnings limit for this purpose. The month matters. A person can work in the same job, earn the same weekly amount, and face a different Social Security result simply because full retirement age arrives in the middle of the year. That is why looking only at age 66 or age 67 is dangerous. Full retirement age is not the same for everyone. For someone born in 1959, full retirement age is 66 and 10 months. For someone born in 1960 or later, it is 67. A person born only a few months after a friend may face a different date and a different number of months under the earnings test. I have seen people assume that Medicare age and Social Security full retirement age are the same. They are not. Medicare eligibility usually begins around age 65. Social Security full retirement age can be later. A person can be on Medicare, receive Social Security, and still be below full retirement age for the earnings test. That one misunderstanding can cost thousands of dollars in temporary withheld benefits. Here is a simple way to picture it. Your 65th birthday opens one door, Medicare. Your Social Security full retirement age opens another door. Those doors may not open on the same day. Walking through the first does not mean the second has opened. Most people never realize this until they are already working and receiving benefits. Another error appears when someone claims retirement early because they believe waiting means losing checks. They count the payments they could receive between age 62 and full retirement age, but they do not always count the permanent reduction in the monthly benefit. For people born in 1960 or later, Starting retirement benefits at 62 can reduce the worker's benefit by about 30% compared with waiting until full retirement age. Waiting beyond full retirement age can increase the benefit further, up to age 70. This does not mean everyone should wait until 70. Health, work, savings, family needs, life expectancy, debt, and survivor planning all matter. The mistake is believing there is one perfect claiming age for every American. There is not. Consider two brothers. James is 62, has serious health concerns, little savings, and cannot continue working. His need for income is immediate. His brother Michael is healthy, still employed, has a pension, and can delay Social Security. The same claiming decision does not fit both men. Now add marriage. When the higher earner delays benefits, the decision may affect not only that worker's monthly retirement payment, but also the financial protection available to a surviving spouse. A married couple that looks only at the first year of retirement can miss the risk that one spouse may live alone for 10 or 15 years. This is where the system becomes emotionally difficult. People make a claiming choice while both spouses are alive, both incomes are coming in, and both people are sharing housing costs. The true cost of the choice may appear years later when one spouse dies and the household loses one Social Security payment while many expenses remain. The electric bill does not fall in half, property tax does not fall in half, home insurance does not fall in half. A roof does not cost half as much because only one person lives under it. Retirement planning is not only about reaching retirement, it is about protecting the person who may be left behind. There is another reason you must read every Social Security notice carefully. Your benefit is built from your earnings record. Social Security uses your highest 35 years of indexed earnings in the retirement calculation. If fewer than 35 years are available, 0 years can enter the formula. If earnings are missing or recorded incorrectly, the result may be smaller than it should be. A missing year may look harmless on a screen. It may have happened decades ago. The employer may no longer exist. You may barely remember the job. But a missing record can affect a benefit paid month after month for the rest of your life. Most people think the government already has everything. Often it does. But usually correct is not the same as never wrong. The responsible action is to review your earnings history through an official Social Security account. Look for years that show 0 when you know you worked. Look for wages that seem far below what you earned. Keep old W-2 forms, tax returns, pay records, or other proof when available. A correction is much easier when evidence still exists. Do not wait until you are 80 and trying to remember an employer from 40 years earlier. This is the point where many retirees feel tired. They spent their lives doing what was asked of them. They paid payroll taxes from every paycheck. They watched Social Security and Medicare taxes leave their wages before the money reached the bank. They were told those programs would provide stability in old age. Then retirement arrives, and stability seems to require constant attention. A notice appears in the mailbox. The print is small. The language sounds formal. One number changes. Another deduction appears. The retiree feels as if the financial world is watching every move while nobody is watching out for the retiree. That feeling is real, but it does not mean the system is secretly targeting you. It means the system is built around records and rules, not around the emotions of the person opening the envelope. A computer can correctly calculate a Medicare premium and still create fear in a widow who does not understand why the amount increased. A bank can correctly hold a suspicious transfer for review and still terrify an elderly customer who needs the money for a medical procedure. Social Security can correctly withhold benefits under an earnings rule and still create a crisis for someone who did not know the rule existed. The mechanism is cold because it has no idea what the money means to you. To the system, $500 may be an adjustment. To you, it may be a month of groceries. To the system, a delayed deposit may be a processing issue. To you, it may be the difference between paying property tax on time and facing a penalty. To the system, a Medicare surcharge may be an income calculation. To you, it may feel like punishment for taking money from an IRA to replace a broken air conditioner. This is why calm knowledge matters. Panic makes people ignore letters, move money too quickly, borrow at high interest, or trust a stranger who promises to fix the problem. Knowledge allows you to slow down, identify the rule, and choose the correct response. There is a smarter way to act, but it begins by accepting one uncomfortable truth. Retirement income is not something you set once and forget. If this information is helping you understand what is happening to your money, leave your like, because more retirees need to see these rules explained before a missing payment or unexpected deduction becomes an emergency. Now we need to look at the rule that quietly pulls more retirees into the federal tax system. Many people believe Social Security is tax-free because payroll taxes were taken from their wages during their working years. That belief is understandable. It is also incomplete. Depending on your filing status and other income, part of your Social Security benefits may be included in taxable income. The IRS uses a calculation that considers your other income, tax-exempt interest, and 1/2 of your Social Security benefits. The basic federal thresholds include $25,000 for many single filers and $32,000 for married couples filing jointly. Depending on the result, up to 85% of Social Security benefits can become taxable. That does not mean the government takes 85% of your check. It means up to 85% may be included in the income on which your tax is calculated. That difference is critical. Suppose a retired couple receives $36,000 a year in combined Social Security benefits. Half of that is $18,000. They also withdraw $30,000 from a traditional IRA and receive $8,000 in pension income. Before considering other details, they are already looking at $56,000 in the kind of combined income calculation that can make part of Social Security taxable. The IRA withdrawal does not only create tax on the IRA money, it can cause more Social Security benefits to enter the taxable calculation. This is sometimes called the tax torpedo because one extra dollar of income can pull another portion of Social Security into taxable income. The retiree thinks, I withdrew $10,000, so I will pay tax on $10,000. The real increase in taxable income may be larger because the withdrawal changes the taxation of Social Security. Here is what almost nobody understands. Money can be completely safe inside a traditional IRA from current income tax, yet become financially expensive when withdrawn at the wrong time or in the wrong amount. The account statement may show $300,000. That does not mean all $300,000 belongs to your future spending. Part may eventually go to federal or state taxes. A withdrawal can affect Social Security taxation. A large withdrawal can affect Medicare premiums in a later year. It can also raise the cost of other income-based programs. $1 can create several reactions. Imagine Linda and Thomas. They are retired, comfortable, but not wealthy. They have Social Security, a small pension, and $420,000 in traditional retirement accounts. Their daughter needs help with a down payment. They withdraw $60,000 in December. They believe they are using their own money, and they are. But because the account was tax-deferred, the withdrawal generally enters taxable income. It may increase the taxable portion of their Social Security. It may move their income closer to a Medicare surcharge threshold. And because the withdrawal happens in December, they have little time left in the year to plan around the result. The check to their daughter may be $60,000. The true financial cost may be more. This is why timing matters. Taking $60,000 in 1 year may produce a different result from taking $30,000 in 1 year and $30,000 in the next, depending on tax brackets, Medicare thresholds, and the family's other income. I am not telling you which choice is correct. I am telling you that the choice should be calculated before the withdrawal, not discovered after the tax forms arrive. This content is educational. It does not replace advice from a qualified financial, tax, accounting, or legal professional who can review your exact records. But education changes the questions you ask. Instead of asking only, "Can I withdraw the money?" you begin asking, "What else changes if I withdraw it?" That second question can protect thousands of dollars. People near retirement need to understand this before leaving work. The final year of wages can overlap with a pension, a retirement plan distribution, and Social Security benefits. A person may retire in September, begin a pension in October, claim Social Security in November, and take money from a 401k to pay off debt in December. 4 separate income events can land on one tax return. The retiree sees a year of transition. The IRS sees 1 calendar year. This changes everything. The same problem appears when people cash out an old 401k instead of rolling it correctly into another eligible retirement account. A check can feel like freedom. But if the transaction is treated as a taxable distribution, taxes and possible penalties may follow. The safest move depends on age, account type, plan rules, and what you do with the money. Never assume that moving retirement money is the same as moving money between ordinary checking accounts. Retirement accounts have labels for a reason. Traditional 401k, Roth 401k, traditional IRA, Roth IRA, inherited IRA, and employer pension are not interchangeable. The IRS does not treat all of them the same. In 2026, the employee contribution limit for many 401k, 403b, governmental 457 plans, and the federal thrift savings plan increased to $24,500. The general catch-up limit for many workers age 50 and older increased to $8,000. For workers ages 60 through 63, a higher catch-up limit of $11,250 may apply in eligible plans. The IRA contribution limit rose to $7,500, with an additional $100 catch-up amount for eligible people age 50 and older. Why does this matter to a retiree already receiving Social Security? Because many people watching right now are not fully retired. They are 60, 62, 65, or 67 and still working. They may have only a few high-income years left. Understanding the limits can help them decide whether to save more, reduce current taxable income, build Roth money, or prepare for required distributions later. But do not make the mistake of believing that a higher contribution limit automatically means you should place every available dollar into a tax-deferred account. Tax deferral is powerful, but it is not tax elimination. You are moving the tax question into the future. The future may include Social Security taxation. The future may include Medicare income surcharges. The future may include required minimum distributions. The future may include a surviving spouse filing as a single taxpayer with narrower tax brackets. The future may include heirs who must withdraw inherited account money under rules that apply at that time. A retirement account is not only a pile of money, it is a future tax schedule. That schedule becomes especially important after the death of a spouse. While both spouses are alive, they may file jointly. After one dies, the survivor may eventually file as a single person. The household may have less Social Security income, but the survivor can still face higher tax pressure because the filing status changed. This is sometimes called the widow's penalty. It is not one official penalty printed on a bill. It is the combined effect of losing one Social Security payment, possibly losing part of a pension, moving from joint to single tax brackets, and facing single-person Medicare income thresholds. Think about the impact of this. A widow may have less household income and yet pay a greater percentage of that income in taxes and Medicare premiums. That is why survivor planning must happen while both spouses are alive. Sit down with the Social Security estimates. Identify the higher earner. Understand what the survivor may receive. Review pension survivor options. Review life insurance. Review beneficiary forms. Review which accounts are traditional and which are Roth. Review whether the surviving spouse can manage the banking, bills, tax documents, and online accounts. This is not pleasant work, but it is protective work. The worst time to explain a complicated retirement system is the week after a funeral. Now we come to Medicare's Income-Related Monthly Adjustment Amount, often called IRMA. This is one of the clearest examples of a charge that feels sudden even though it was created by an older tax return. For 2026, the standard Medicare Part B premium is $202.90 a month, but beneficiaries with higher modified adjusted gross income can pay more. For many individual filers, the first higher income tier begins above $109,000. For married couples filing jointly, it begins above $218,000. At the highest listed tier, the total 2026 Part B premium can reach $689.90 a month per person. Part D can also have a separate income-related amount. This helps both lower-income retirees and comfortable middle-class retirees to understand, because the risk is not limited to millionaires. A couple can cross a threshold in a year when they sell property, convert a large traditional IRA amount to Roth, realize investment gains, receive a business payment, or take a large retirement distribution. The surcharge may arrive later when their current income is much lower. Imagine Edward and Susan. In 2024, both were working. Their income was strong. In 2025, they retired. By 2026, their household income has fallen sharply. Then they receive a Medicare notice showing higher premiums based on income from the earlier period. They feel punished for income they no longer receive. The calculation may be based on valid tax data, but this is not always the end of the story. If a qualifying life-changing event caused household income to fall, a beneficiary may request a lower IRMA-A using Form SSA 44. Social Security lists events such as marriage, divorce, death of a spouse, work stoppage, work reduction, loss of income producing property under certain conditions, loss or reduction of pension income, and certain employer settlement payments. Documentation is required. This is not automatic. You have to claim the review. Pay close attention to the words life-changing event. Simply disliking the premium is not enough. A bad investment decision is not automatically a qualifying event. A voluntary large withdrawal from an IRA is not automatically treated the same as stopping work. The form requires facts and proof. But many eligible retirees never ask. They receive the notice, assume the government must be right, and pay the higher premium for the year. The underlying tax data may be right, yet the older income may no longer represent their current life. Nobody is going to tell you about this at the moment you retire unless you ask the right question. The action is simple to understand even when the paperwork is not. When a Medicare income surcharge appears, do not panic. Identify which tax year was used. Compare that income with your current income. Determine whether a listed life-changing event occurred. Gather proof. Read the appeal or reconsideration instructions. Use official Social Security channels. Do not pay a stranger from an unsolicited phone call to remove the surcharge. The government will not call you and demand gift cards, cryptocurrency, gold bars, or cash to protect your Social Security number. A real agency does not need you to move money into a so-called safe account. A real bank fraud department does not need your online password or one-time security code. This is where financial fear becomes profitable for criminals. They know retirees are worried about benefit changes, Medicare costs, IRS notices, and frozen accounts. They create urgency. They say your Social Security number has been suspended. They say a car was found in your name. They say the IRS is preparing an arrest. They say the bank account is under investigation. Then they offer one immediate solution: move the money. The more frightened you become, the less time you spend checking. The protection is to slow the transaction down. End the call. Use the phone number printed on an official statement or the back of your bank card. Type the official government address yourself. Do not use a link sent in a message from a stranger. Do not trust caller identification. Telephone numbers can be made to look familiar. A legitimate problem will still exist after you take 10 minutes to verify it. A scam depends on preventing that verification. Now tell me in the comments whether you already knew that a life-changing event may allow some retirees to request a lower Medicare income surcharge, or whether you are hearing about Form SSA 44 for the first time. There is another major Social Security change that affected millions of public workers and their families. The Social Security Fairness Act ended the windfall elimination provision and the government pension offset. Those rules had reduced or eliminated certain Social Security benefits for people who also receive pensions from work that was not covered by Social Security, including some teachers, police officers, firefighters, federal workers, and people with foreign pensions. For benefits payable for January 2024 and later, WEP and GPO no longer apply. Social Security began issuing retroactive payments and increasing monthly benefits for many affected people, while some complex cases required individual review. This was a major correction for people who spent years believing they did not qualify for a meaningful benefit. But most people think they do not qualify because of something they were told 10 or 20 years ago. That old answer may no longer be the right answer. A retired teacher may have asked about spousal benefits years ago and been told that the government pension offset would reduce the payment to zero. A retired police officer may have seen his own Social Security retirement benefit reduced by the windfall elimination provision. A widow may have believed a survivor claim was useless because of the pension offset. The repeal changes the calculation, but this is not a reason to assume every person will receive the same increase. The amount depends on the individual record, pension, work history, benefit type, and whether an application was filed. Some people were already receiving reduced benefits. Others never applied because they believed the benefit would disappear under the old rule. You have to claim it. That sentence matters. Social Security cannot always pay a benefit that was never properly applied for. A change in law does not mean every eligible person will instantly understand which claim to file. If you or your spouse worked in a job that did not withhold Social Security taxes, review the new rules through official Social Security information. Do not rely on a conversation from 2018. Do not rely on a retired coworker's result. Do not assume that a pension statement tells the full story. One household can include several possible benefits: a worker's retirement benefit, a spousal benefit, a divorced spouse benefit, a survivor benefit, or benefits connected to disability. The highest amount may change after a death, divorce, new filing, corrected record, or change in law. This is why I keep repeating that Social Security is not automatic. Some increases happen automatically for people already on the correct record. Other benefits require an application. Some corrections require evidence. Some disputes require an appeal within a deadline. The system will process what is in the record. It cannot protect you from a claim you never make. Now let us talk about banks, because this is where many retirees begin to feel that every dollar is being watched. Banks in the United States operate under rules that require identity checks, record keeping, fraud controls, and reporting of certain activity. Federal law generally requires financial institutions to report cash transactions over $10,000, including multiple cash transactions that total more than $10,000 in one business day. Banks also file reports when activity appears suspicious under anti-money laundering rules. A report does not automatically mean that a customer committed a crime. The dangerous mistake is trying to avoid a normal cash report by dividing transactions into smaller amounts. Deliberately breaking up cash deposits to evade reporting requirements can be treated as structuring even when the money itself came from a lawful source. Imagine a retiree sells equipment from an old family business and receives $18,000 in cash. A friend tells him, "Do not deposit more than $10,000. Put in $9,000 this week and $9,000 next week so the bank does not ask questions." That advice can create a much larger problem. The correct question is not, "How do I avoid the bank's report?" The correct question is, "How do I document the lawful source of the money and make the deposit honestly?" Bring the sales agreement. Keep the receipt. Keep records showing where the money came from. Answer reasonable questions. Never create a pattern designed to hide the total. Most ordinary retirees will never face a serious investigation, but many will experience a delayed transfer, identity check, unusual activity alert, card block, or request for additional information. These systems use computer models to compare behavior. A person who usually spends $80 at local stores and suddenly sends $15,000 to a new recipient may trigger review. That does not mean the bank knows you are doing something wrong. It means the transaction looks different from your normal pattern. The same type of automated review can protect you from fraud. It can also delay a legitimate payment. That is why large transfers should not be left until the final hour before a closing, tax deadline, medical procedure, or emergency. Verify wiring instructions directly with the recipient using a known phone number. Criminals can enter an email conversation and replace valid instructions with their own bank details. A message can look exactly like it came from the title company, attorney, contractor, or family member. The retiree presses send, the bank transfer leaves. Minutes later, the real company says the payment never arrived. That loss may be far larger than any Social Security adjustment discussed in this video. Bank protection is not only about earning interest, it is about controlling access. Use separate strong passwords. Turn on transaction alerts. Review statements. Keep a trusted contact when appropriate. Do not give family members your password simply because they occasionally help with bills. Consider a properly designed power of attorney with legal guidance if someone may need to act for you in the future. A password is not an estate plan. Writing your banking password on a piece of paper for one child can create conflict, security risk, and legal confusion. The child may need authority, not just access. This becomes urgent when cognitive decline, hospitalization, or sudden illness enters the family. A healthy 68-year-old may manage every account perfectly. At 78, a stroke can change everything in one afternoon. Bills continue. Social Security continues. Medicare notices continue. Tax forms continue. The bank may refuse to discuss the account with a son or daughter who has no legal authority. Families often discover this too late. Protection requires more than a will. A will controls property after death. It does not automatically give someone power to manage your finances while you are alive and unable to act. Depending on your situation, you may need a durable financial power of attorney, healthcare documents, updated beneficiaries, trusted contacts, and clear instructions about where records are kept. Do not download a random form and assume it solves every problem. State law matters. Account titles matter. Bank procedures matter. Professional legal advice can prevent a cheap form from becoming an expensive court case. Inheritance creates another quiet danger. People believe that naming one child on a bank account is an easy way to avoid probate. Sometimes joint ownership or payable on death designations can be useful, but they can also produce results that do not match the family's intentions. Suppose a mother has 3 children. She adds one daughter as a joint owner because that daughter lives nearby and helps pay bills. The mother's will says all 3 children should inherit equally. After the mother dies, the bank account may pass according to the account title or beneficiary designation, not according to the sentence in the will. The daughter may legally receive the entire account. The other children may believe she was only helping. A family can be destroyed over money the mother thought was clearly divided. Beneficiary forms can override the will on retirement accounts and insurance policies. An old spouse can remain named. A deceased beneficiary can remain listed. A child born later can be missing. A trust can be named incorrectly. Nobody is going to review these forms for you every year. You have to check them. Look at the actual beneficiary record, not only your memory. Ask for confirmation. Review primary and contingent beneficiaries. Update records after marriage, divorce, death, birth, or major family change. Understand that an inherited retirement account may carry tax rules for the person who receives it. The person who inherits $100,000 in a traditional IRA may not have $100,000 of tax-free spending money. The label on the account follows the money. This is why retirement protection is larger than Social Security. Social Security may be the foundation, but your bank account, retirement accounts, home insurance, taxes, Medicare, credit, and estate documents all sit on that foundation. If you want to continue receiving calm explanations of rules that can affect your retirement money, consider subscribing to the channel and activating notifications so you do not miss the next videos. Now we are approaching the most important part, because the strongest danger is not one rule by itself. It is the chain reaction created when several normal decisions happen in the same year. Imagine a couple named Frank and Mary. Frank is 73, Mary is 69. They receive $46,000 a year in combined Social Security. Frank has a pension of $22,000. They have $510,000 in traditional retirement accounts. Their home is paid off, so they believe they are financially safe. Then 3 things happen. The county raises their property tax. Their heating system fails. Their adult son loses his job and needs help. Frank withdraws $70,000 from his traditional IRA. The withdrawal is legal. The money belongs to them. The bank accepts the deposit. They pay the heating company, help their son, and set aside money for property tax. The immediate crisis is solved. But the withdrawal enters the tax system. It increases their income for the year. A larger portion of their Social Security may become taxable. Their federal tax bill may rise. Depending on the full calculation, the income may later affect their Medicare premiums. The couple may need larger future withdrawals to pay the tax created by the first withdrawal. That second withdrawal can create more taxable income. This is the silent gear turning behind retirement. Withdrawal creates income. Income affects Social Security taxation. Income can affect Medicare. Higher costs require more withdrawals. More withdrawals create more income. The retiree sees bills. The system sees numbers feeding other numbers. Now imagine that Frank dies the following year. Mary loses one Social Security payment. She may lose part of the pension, depending on the survivor election they made years earlier. She eventually files taxes as a single person. The remaining traditional IRA is now attached to one taxpayer instead of 2. The same account balance can become more difficult to manage. This is the true climax. The most dangerous Social Security change is not always the one announced in a press release. It is the way a change in one part of retirement can move you across a line in another part. A cost of living increase can raise gross income. A Medicare premium increase can take part of the gain. A work decision can cause benefits to be withheld before full retirement age. An IRA withdrawal can increase taxable income. Higher income can make more Social Security taxable. The same income can later create Medicare surcharges. The death of a spouse can reduce household benefits and change tax filing status. A banking delay can prevent access to money at the exact moment the household needs it. Every gear is lawful. Every gear is quiet. Most people never see the full machine. That is why people who appear financially comfortable can feel trapped. A couple may own a $400,000 home and have $500,000 in retirement accounts, yet worry about a $3,000 medical bill. The home does not pay the pharmacy. The retirement account may create tax when accessed. Social Security may already be committed to food, utilities, insurance, and taxes. Net worth is not the same as cash flow. Account balance is not the same as spendable money. A benefit increase is not the same as greater buying power. Here is the protection method I have trusted for years. Before making a large financial move, draw a circle around the decision and ask which systems it touches. If you stop working, it may touch Social Security claiming, employer insurance, Medicare enrollment, pension elections, taxes, and cash flow. If you take a large IRA withdrawal, it may touch income tax, Social Security taxation, Medicare premiums, investment growth, and inheritance. If you sell a home, it may touch capital gains, Medicare income, housing costs, property tax, and the safety of the money after closing. If you add a child to an account, it may touch ownership, creditor risk, taxes, estate plans, and family inheritance. If you return to work, it may touch the earnings test, taxes, health coverage, and your future Social Security calculation. Do not make a 5-system decision using a 1-system answer. A bank employee may understand the bank account but not your Medicare surcharge. A real estate agent may understand the sale but not your Social Security taxation. A retirement representative may understand the investment but not your estate plan. A tax preparer may accurately report last year while giving no advice about next year. You may need several professionals. More importantly, those professionals need to know what the others are doing. Ask for the calculation in dollars. Do not accept only words like probably, usually, or should be fine when a major amount is involved. Ask, how much could become taxable? Ask, which year can affect Medicare? Ask, will this count under the Social Security earnings test? Ask, what happens if my spouse dies first? Ask, does this beneficiary form agree with my will and trust? Ask, what is the net amount after every deduction? Simple questions expose hidden costs. Another protective step is to build a retirement file. Keep Social Security notices, Medicare notices, recent tax returns, Form SSA 1099, pension statements, retirement account statements, beneficiary confirmations, insurance policies, property records, powers of attorney, and contact information for trusted professionals. The file can be paper, secure digital storage, or both. The important part is that a trusted person knows it exists and can find it during an emergency. Do not place every password in an unlocked folder labeled bank accounts. Security and access must be balanced. A password manager, secure document system, or legal plan may help. The exact method matters less than avoiding two extremes, leaving everything exposed or leaving everything impossible to find. Review automatic payments. Retirees often carry small monthly charges for services they no longer use. $10 here, $14 there, $39 somewhere else. One charge is not frightening. 20 charges can drain hundreds of dollars every month. Banks benefit when customers stop paying attention. Insurance companies benefit when policies renew without review. Subscription companies benefit when a person forgets the charge. The system favors the person who understands the game. This does not mean every company is dishonest. It means many business models depend on your silence. The same is true with credit. A retiree with strong credit may receive constant offers to borrow against a home, open cards, transfer balances, or finance purchases. Credit can be useful, but retirement changes the risk because wages may no longer be available to repair a mistake. A home equity loan can create cash today and a required payment for years. A reverse mortgage can help some households but includes costs, rules, and long-term effects that must be understood. A 0% card can become expensive when the promotional period ends. A co-signed loan for a child or grandchild can damage the retiree's credit if the borrower misses payments. Love does not remove your legal responsibility from a co-signed debt. The lender can pursue the co-signer. The missed payment can appear on the co-signer's credit. The retirement budget can be damaged by a loan the retiree never personally used. Never co-sign because someone says, "It is only a formality." If the lender did not believe the borrower alone could safely repay, your signature is not a formality. It is the protection the lender wants. Older Americans are often targeted because they have home equity, retirement savings, stable deposits, and a desire to help family. The pressure may come from a criminal, a salesperson, or someone they love. Protection sometimes requires saying no. That can feel cruel in the moment. Losing your home at 78 is crueler. There is also the risk of tax debt. Social Security benefits can be subject to certain legal deductions or offsets in specific situations, including some federal debts, tax levies, child support, or restitution. The rules and protected amounts vary. Never assume a government debt will disappear simply because you retired. Open every official notice. A tax problem ignored for 6 months is usually harder than the same problem addressed in the first 30 days. Deadlines matter. Appeal rights matter. Payment plan options matter. Records matter. At the same time, verify the notice. Criminals create letters that look official. Compare contact information with an official government source. Do not call a telephone number simply because it appears in a threatening message. Fear creates speed. Protection creates verification. The Federal Reserve affects retirees in another indirect way. When interest rates rise, savings accounts and certificates of deposit may pay more, but credit cards, adjustable loans, and other borrowing can become more expensive. Bond prices can move. Banks can change deposit rates faster than many older customers notice. A retiree may leave $80,000 in an account, paying almost nothing, while the same bank offers a much higher rate in another account. The bank is not required to move you automatically into its best product. This is not automatic. You have to compare rates, insurance coverage, withdrawal rules, maturity dates, penalties, and access. Do not chase a slightly higher rate into a product you do not understand. But do not assume loyalty will be rewarded without asking. A bank may happily keep your money in a low-paying account for years. The quiet loss is not a fee printed in red. It is the interest you never received. Inflation makes that loss worse. If an account earns 1% while your living costs rise faster, the balance may look stable while purchasing power falls. This is the same illusion that appears with Social Security. The number can rise while your life becomes harder to afford. The solution is not fear. The solution is measurement. Once a year, calculate the household's true retirement income after Medicare, tax withholding, insurance, debt payments, and recurring bills. Compare that net income with the previous year. Then compare essential expenses. Do not ask only, did my Social Security increase? Ask, did the amount left after essential expenses increase? That is the number that controls your peace. When you receive the next Social Security notice, place it beside the previous notice. Compare the gross benefit, compare Medicare Part B, compare any income-related adjustment, compare federal tax withholding, compare other deductions. Then check the first deposit after the change. When you receive a Medicare notice, identify whether it shows the standard premium or an income-related amount. If income has fallen because of a qualifying event, investigate Form SSA 44 promptly. When you work while receiving Social Security before full retirement age, estimate wages honestly and update the estimate when your hours change. When you plan a large traditional IRA or 401k withdrawal, calculate the effect before pressing the button. When a spouse dies, review Social Security survivor rights, Medicare, taxes, pension elections, banking authority, beneficiaries, and household cash flow. Do not assume every agency and company will coordinate automatically. When a bank questions a large transaction, remain calm, provide lawful documentation, and never divide cash deposits to hide the total. When someone calls with a threat, hang up and verify independently. These actions sound small. That is why they work. Financial protection rarely looks dramatic. It looks like reading one letter twice. It looks like making one phone call before a deadline. It looks like saving a document. It looks like asking a professional to calculate the tax effect before a withdrawal. It looks like refusing to send money while someone is rushing you. The people who keep more of what they built are not always the people with the highest income. They are often the people who notice earlier. I want to speak directly to the person who feels behind. Maybe you claimed Social Security without understanding every rule. Maybe you withdrew too much from an IRA. Maybe you ignored a Medicare notice. Maybe you trusted someone at a bank who did not explain the full impact. Maybe you are already worried about taxes. Do not let embarrassment create a second loss. You cannot change a decision by pretending it did not happen. You can review the record, correct what can be corrected, appeal what can be appealed, adjust future withdrawals, change withholding, update beneficiaries, reduce unnecessary costs, and build a better plan for the next year. There is still time to act more intelligently. The system is complicated, but complicated does not mean impossible. Start with the dollar leaving your Social Security benefit. Understand every deduction. Then look at the income entering your tax return. Then look at what Medicare is using. Then look at the retirement accounts that can create future income. One connection at a time. You do not need to become an accountant. You need to know when a decision touches taxes. You do not need to become a lawyer. You need to know when ownership and beneficiary forms can override your intentions. You do not need to become a banker. You need to know how to verify a transfer and protect access. You do not need to work at Social Security. You need to understand that this is not automatic. Most people think they do not qualify. Nobody is going to tell them about every option, and many benefits must be claimed. That knowledge is power because it changes behavior before the loss occurs. A retiree who knows about the earnings test can update an earnings estimate. A widow who knows about IRMAE can ask whether Form SSA 44 applies. A public worker who knows WEP and GPO ended can review eligibility under the new rules. A couple who understands the tax effect of IRA withdrawals can plan the timing. A family that understands bank ownership can update an estate plan. Before conflict begins, a Social Security increase is helpful, but the increase alone will not protect you. Protection comes from understanding what happens before the deposit, what happens after the deposit, and what happens when another financial decision changes the calculation. You worked too many years to let small hidden rules slowly take control of your retirement. Read the notice, check the record, question the deduction, document the transaction. Calculate before withdrawing. Verify before sending. Claim what requires a claim. Appeal what deserves review. And never allow fear to force you into a financial decision before you understand who benefits from your speed. The system may be silent, but you do not have to remain blind to it. Share this video with a retired friend, a spouse, a parent, a veteran, a teacher, a firefighter, a police officer, or anyone approaching retirement. One rule explained at the right time can protect years of savings. And if you believe this is important, watch the next video appearing on the screen now. In it, I explain another financial situation that can directly affect the money of millions of Americans and that most retirees do not notice until the loss has already begun.